Now I have everything I need. Let me write the complete 5,000 plus word script. Here is something that happened to an accountant I know. He had a client, a building contractor from Cincinnati, who crossed $1 million in net worth on a specific Tuesday in 2023. Not metaphorically. The man could identify the Tuesday. That's when his index funds, combined with his home equity and a commercial property he'd held for 11 years, added up to $1,040,000. And by that Friday, two things had happened without him doing anything. His financial advisor called him for the first time in 8 months with a noticeably different tone. And his sister, whom he hadn't heard from since Thanksgiving, texted asking if he'd have time to talk about something. He thought the $1 million was an arrival. It wasn't. It was the beginning of a completely different game. A game where being a millionaire gets you the attention of exactly the wrong kind of financial product and makes you invisible to exactly the right kind of investment opportunity. And here's the layer that took me years of working with accountants and fiscal lawyers to fully understand. The $1 million mark isn't even the most consequential of the 3 thresholds. There's one below it you'll feel before you understand it, and one above it that changes the mathematical rules entirely, a threshold. Most financial content refuses to name, specifically because the people who benefit from you not knowing it are the same people producing that content. There are 3 exact levels where the institutions, people, and investment universe around you perform a complete and irreversible recalibration. I'm going to show you all 3 with the actual regulatory definitions, the specific dollar amounts, the names of the institutions, and the precise mechanisms behind why each shift happens when it does. Because the gap between knowing these thresholds and not knowing them isn't philosophical, it's compounding. Here's a framework I'm going to use. Think of it like a hotel, not a Marriott, one of those buildings where the elevator panel has buttons you don't know to press if nobody tells you they exist. The lobby is visible to everyone. Floors 1 through 10 are where most Americans spend their entire financial lives. Accessible if you work hard, save consistently, invest with discipline over time. But at a certain number, there's a second elevator bank on the east side of the building. You cannot see it from the lobby. It goes to floors that aren't listed on the directory. And the guests on those floors aren't more talented than the people in the lobby. They're not luckier, they didn't start with more, and they didn't take smarter risks. They know the second elevator exists. That's what today's video is about. Not inspiration, not motivation, just the map of where those elevators are and exactly what key card unlocks each one. In a few minutes, I'm going to show you why the $1 million mark is genuinely more dangerous than it looks. Not in the way you'd expect, but in the specific way that a false finish line is dangerous. But let me start at the top of the building, because that's the part that reorients everything else. There's a man I know indirectly through my professional network. His name for this story is Dennis. Dennis ran a construction company in Ohio for about 20 years. He drove a used pickup truck for most of those years. He was not flashy. He was disciplined with his money in the way that people who grew up without it tend to be, quietly, without drama, without anyone watching. By his late 40s, he had accumulated approximately $6 million in investable assets. Not net worth, investable assets. Mostly commercial real estate, equity, and diversified index funds he'd bought over decades and never touched during panics. Not spectacular by any standard you'd read in a business magazine. Boring, almost. And then, within about 18 months of crossing that $6 million threshold, Dennis started getting a different kind of call. Not cold calls trying to sell him something. Specific offers, a private credit fund his current financial advisor couldn't access. A co-investment deal alongside a family office operating in the industrial real estate sector. A venture capital vehicle that was available only to investors meeting a threshold Dennis had never heard of. He had been investing for 20 years and had never been offered anything resembling this. He assumed he was getting lucky. He wasn't. He had crossed a regulatory designation that almost nobody outside the financial industry knows the name of: the qualified purchaser. Established under Section 2 of 51 of the Investment Company Act of 1940. A qualified purchaser is an individual or entity that meets financial criteria established under the Investment Company Act, identifying investors considered financially advanced and capable of evaluating and bearing the risks associated with complex investment options. And this status allows them to invest in certain unregistered securities private equity investments, and funds that are not available to retail investors. The threshold, according to Section 2 of 51 and Rule 2 of 51, qualified purchasers are individuals who own $5 million or more in investments, excluding primary residence and property used in business. Not $5 million in net worth, $5 million in investments. That distinction is enormous. If you have a paid-off house worth $800,000 and $2.8 million in brokerage and retirement accounts, you have roughly $3.6 million in net worth. You are not a qualified purchaser. Your home is furniture in the lobby. Here's what that threshold unlocks that the tier below it, the accredited investor at $1 million, does not. Accredited investors are permitted to invest in a wider range of assets, including pre-IPO companies, private credit and equity, venture capital, and hedge funds. That's the $1 million line, and only about 19% of US households qualified as accredited investors in 2022, according to SEC estimates. But the qualified purchaser at $5 million unlocks a tier above that. Section 3. See 7 funds, private fund structures that do not have to register with the SEC and that are completely off limits to the accredited investor pool. We're talking institutional grade private credit, private equity, co-investments. Fund-of-fund structures that the average wealth management client in the $1 to $5 million band will never see on a term sheet. And I want to give you the actual performance data here because I'm not going to run this as a trust me claim. I'm going to give you the numbers and the honest nuance. Since 2000, private equity has generated a net annualized time-weighted return of 13% according to MSCI Private Capital Solutions, compared favorably to public equities, the Russell 3000, which generated an 8% net return over the same period. Now, I need to be careful with this because recency matters, and I'm not going to cherry pick. Buyout funds underperformed US and global public equities for the 3rd consecutive year in 2025, generating returns of approximately 7% compared with the S&P 500's 18%. So I'm not telling you private markets are a guaranteed outperformance machine in any calendar year. What I am telling you is this: private credit remains undefeated across 23 straight years of outperforming the public markets, according to Hamilton Lane's 2025 market data. And in the last 10 years, the top quartile of buyout funds at 24% IRR has historically beaten both the S&P 500 at 15% total shareholder return and MSCI World at 13%. The performance story is about access to specific vehicles, not access to private markets in aggregate. Hamilton Lane estimates that $1 invested in private equity in 2015 would have grown to $3.96 by 2024, outpacing the S&P 500 at $3.51. That's not a dramatic gap, but compounded over the full wealth-building arc of someone like Dennis, over 20 or 30 years, the difference between playing one compounding game and having the option to play 2 simultaneously is the number that actually explains how the gap between the UBS elder siblings tier and the everyday millionaire tier has been widening every single year. Everyday millionaires are largely confined to public markets, the same index funds and 401k allocations that powered their ascent. The elder siblings have access to private equity, private credit, co-investment opportunities, alongside family offices and alternative asset classes that have, over the past decade, consistently outperformed public equity on a risk-adjusted basis. That's the second elevator bank on the east side of the building. $5 million in investments. Not real estate equity, not the car, not the primary home, investments. And let me put one more number on the table before we move to the reversal. JP Morgan requires $10 million, doubled from $5 million in 2016. Goldman Sachs requires $10 million, as their private wealth management service typically requires clients to invest $10 million to qualify. Bank of America, private bank minimum requirement is $10 million. You could have $9,999,000 and JP Morgan's private banking division would politely direct you to a website. The lobby is very comfortable. It is still the lobby. By the way, if this kind of institutional analysis of how the financial system actually works is what you want from this channel, hit subscribe right now. I read the SEC filings and Fed survey data and actuarial tables, and I translate them into something actionable. YouTube's algorithm is genuinely unpredictable about who sees what. And if you're not subscribed, my next video may never surface for you. Now, here is the reversal I've been building toward. And this is the one that matters most. You think the problem at the $1 million level is that you haven't accumulated enough yet. You think the solution is simply more time, more contributions, more compounding. And that's not wrong. Accumulation matters. But it's also not the full story. Because crossing the $1 million threshold comes with a specific institutional trap that is calibrated to work against your continued accumulation. And the financial system is incentivized to make sure you don't notice it until the compounding has already run in the wrong direction for years. Here's the number that framed this for me. The United States added more than 441,000 new millionaires in 2025 alone, over 1,200 every day, representing nearly half of all new millionaires globally, per the 2026 UBS Global Wealth Report. 1,200 new millionaires every single day. For context, in 2023, $192,000 was the median household net worth in the United States, up from $121,000 in 2020. The median American household has roughly $200,000 in net worth, and this country is producing 1,200 new millionaires a day. The $1 million mark is rapidly becoming the entry point of the financially disciplined middle class, not the affluent class, the disciplined middle class. And while more households are crossing the $1 million threshold, the households immediately above them are accumulating wealth at a meaningfully faster pace. The finish line is moving every day. I also want you to meet someone before we go deeper. His name is Marcus. He's a composite, a software engineer in his early 40s. His wife works in healthcare administration, combined income around $210,000. And I'm going to bring him back later in this video because his story is the case study that pulls everything together to hold him in mind. Let me now tell you about Paul. Paul is a different composite, built from a different pattern I've watched repeat in the people around me over the years. Paul was a mechanical engineer in his early 50s. 20 years of maxing out his 401k, living in the same house, driving practical cars, no lifestyle inflation. By 51, he had crossed $1.2 million in net worth. He was, in his own words, ecstatic. He had won the game. Within 3 months of that number appearing on his statements, Paul's financial advisor, a broker at a mid-sized firm, not a registered investment advisor, not a fiduciary, upgraded Paul's relationship tier and started scheduling weekly calls. The tone was reassuring. "You've built something real, Paul. Let's protect it." Products followed, annuities, a managed portfolio with a 1.25% annual fee. "You've arrived. Let's keep you here." Here's what Paul did not know. That 1.25% annual management fee on $1,200,000 over 25 years of compounding growth at the historical average market rate of roughly 8% costs him somewhere in the range of $380,000 in lost compounding. Not a line item he pays in a check. Not a fee he'd notice on a quarterly statement that's buried in percentage language. A tax on staying in place that compounds invisibly against him every single year, running in exact opposition to the compound interest he spent 20 years building. And here is what makes this a systems observation rather than a villain story. Paul's advisor is not breaking any law. Most private banks are not fiduciaries. Their advisors are often commission-based and may recommend the bank's products. Private banking may charge less upfront, but earns revenue through product commissions. Picture a physician who is legally permitted to prescribe the medication that generates the highest commission for him, not the one best calibrated to your specific condition. Not illegal, not in your best interest. That is the legal architecture most Americans encounter when they cross the $1 million threshold and start receiving calls from financial advisors. The standard they operate under is the suitability standard. They must recommend something suitable, not something optimal. Americans believe it takes $839,000 to be financially comfortable, according to Charles Schwab's 2025 Modern Wealth Survey. And Americans now think it takes an average of $2.3 million to be considered wealthy. The gap between those two survey responses, between comfortable and wealthy, is exactly the territory where this trap operates. You're visible enough to attract the wrong kind of institutional attention. You're not yet wealthy enough to attract the right kind. And the advisor on the other end of the call is operating within a system that is legally calibrated to profit from you staying exactly where you are, rather than urgently helping you get to the next floor. Here is the part that never makes it into a standard retirement calculator. And this is where I want to mention something I built specifically because of this gap. You can do everything right, contribute consistently, invest in low-cost index funds, build to $1 million, and still end up significantly behind where your number should put you because of structural costs that attach specifically to this wealth level and compound invisibly. I put together a digital book called The Exit Code because this calculation is genuinely hard to find in one place anywhere else. 8 chapters, 50 years of actual retirement data, no filler. The things it covers include the dynamic withdrawal method that replaces the 4% rule. Most advisors still quote a method derived from the research rather than invented in 1994 and never updated. The $14,000 invisible bill, the annual insurance gap that destroys households between 60 and Medicare eligibility, which most retirement plans don't model at all. And the 58% rule, the documented statistical probability that someone in their mid to late 50s will be forced out of employment before they plan to leave. That's not a scare tactic. That's the number from longitudinal workforce research. And a retirement plan that doesn't account for it is like building a house without accounting for weather. You can get the exit code for less than one dinner out through the link in the description. The urgency isn't marketing, it's compounding. Every year this framework sits unread. The math is working against you. Now, back to the first threshold, the one below the $1 million mark. Because this is the level people feel before they understand it. And misreading it is more expensive emotionally than financially. Here is the Terrence story. Terrence worked in IT management for 20 years. Consistent income, consistent savings rate, no flash, no drama. By 44, he had accumulated roughly $600,000 in net worth. About half in home equity, the rest between retirement accounts and a modest brokerage account he'd been adding to slowly since his early 30s. He hadn't changed his lifestyle. He hadn't told anyone the number. He was driving the same car he'd had for 6 years. But within 2 years of crossing that threshold, 4 things happened without him changing anything about his behavior. His brother-in-law asked him to co-sign a business loan. His college roommate mentioned Terrence's success at a reunion in a way that was directed at the room, not at Terrence. His parents started gently asking whether he'd thought about estate planning, which decoded with minimal effort to, "Have you thought about what happens to your money when you die?" And his financial advisor upgraded him to a premium service tier and started scheduling quarterly review calls. None of these people knew the exact number. But money leaves a behavioral footprint long before it leaves a paper trail. High net worth individuals frequently report a paradox: increased power paired with decreased trust. Relationships become harder to evaluate. This is documented in behavioral psychology research, and it maps precisely to what happens in the $500,000 to $1 million range. The way you stop flinching when a group check comes, the way you agree to a vacation without running the math out loud, the casual confidence in making reservations. People who love you pick up on it. People who have a complicated relationship with you pick up on it faster. High income frequently triggers lifestyle inflation. Consuming every raise and bonus, competent professionals surround themselves with other high earners, creating social environments where expensive tastes become the norm. The doctor, lawyer, or tech executive earning a large salary often has less net worth than a disciplined middle-income earner who consistently lives below their means. Terrence is in the latter category. He built his $600,000 by doing almost nothing interesting, by not upgrading his car every 3 years, by not moving to a neighborhood that matched his income rather than his net worth, by keeping his savings rate elevated even when raises arrived. And the result is that he gets treated as wealthy at exactly the moment he's most at risk of being talked out of the habits that built him there. Wealth creates social filtering. And below the $1 million mark, that filtering is almost entirely social rather than institutional. The big banks haven't noticed you yet, not really, but the people around you have. And this creates what I think of as relationship-based financial pressure. The requests, the assumptions, the conversations that now carry an implicit dollar sign that your social network is reading into your interactions. There's a specific behavioral trap embedded in this level that I want to name. Analysis across wealth bands from mass affluent to billionaire shows clear transitions as individuals ascend the wealth ladder. Their language becomes more deliberate and less spontaneous. The people at the levels above this one have learned to be careful about what they share and with whom, not out of paranoia, out of rational response to the trust erosion that happens at every threshold above $500,000. Terrence isn't being paranoid when he notices that a cousin he hasn't talked to in 4 years suddenly has a very interesting business idea. He's observing a systematic and well-documented social response to perceived wealth. The trap is letting the social pressure of level 1 change the financial behaviors that built you there. The Schwab 2025 survey found Americans believe $839,000 is the threshold of financial comfort, which means that at $600,000, you look comfortable to everyone around you, while you yourself may not feel it. You're close enough to the number to feel the social weight of it, but not yet through the other side. That gap between their perception of your situation and your internal experience of it is where the behavioral risk of level 1 lives. It's the no man's land of wealth, visible enough to attract attention, not secure enough to be indifferent to it. And before I give you the synthesis that ties all 3 levels together, let me resolve Marcus. Marcus, software engineer in North Carolina, wife in healthcare administration, net worth in 2020, $200,000. Mostly home equity, a 401k nobody touched since 2012, a small brokerage account. Marcus and his wife are relentlessly boring with money. They automate everything. They raise their contribution rate 1% every time they get a raise. They don't trade on news. They don't try to outguess the market. They hold index funds they never think about. And by 2025, 5 years later, their net worth is at $840,000. A combination of consistent contributions, home equity appreciation, and a small rental property purchased in 2022. Marcus has crossed level 1. He notices the social shift exactly as I've described it. His in-laws start asking his opinion on financial topics. 3 cousins reach out with business ideas within 8 months of a family gathering where his success was apparently discussed. He finds it flattering and exhausting in roughly equal measure. His financial advisor starts recommending managed products he hadn't mentioned before. Marcus reads the terms on every product. He declines them all. He keeps it boring. Now apply the historical 8% annual return on diversified equity not guaranteed, but the 50-year baseline from the Federal Reserve data plus continued contributions. By 2028, Marcus and his wife are at approximately $1.2 million. Level 2, 3 separate financial advisors reach out within 6 months as if someone sent them a notification. None of them can offer him access to the private credit vehicle his professional network has started discussing. He is in the top 10% of American household wealth, the top decile of US households, which requires a net worth of roughly $1.22 million as a threshold, according to Federal Reserve analysis. And Marcus is playing exactly the same public markets game he started with at $200,000. Same index funds, same ETFs, same public equity exposure. The second elevator keycard doesn't exist for him yet. But Marcus, who has spent 4 years reading the actual documents, understands what the threshold is. He keeps going. By 2032, again, historical returns plus contributions plus appreciation on the rental property, Marcus is approaching $4.8 million in total assets, with roughly $4.3 million in investable assets. Within 18 months of that, the conversations he has change structurally. Someone offers him access to a private credit fund, a co-investment alongside a family office operating in commercial logistics, a venture vehicle not available on any public platform. Same Marcus, same boring habits. He has been running since 2020. Completely different floor of the building. The gap between Marcus at 1 million and Marcus at 5 million is not a matter of degree. While more households are crossing the $1 million threshold, the households immediately above them are accumulating wealth at a meaningfully faster pace. The difference isn't just how much money you have, it's which compounding engine you're running. Here's what ties all three levels together, and this is the frame I want you to take away from this video. You think these are three separate phenomena: a social problem at $500,000 to $1 million, an institutional problem at $1 million to $5 million, and an investment access problem above $5 million. That's how most people experience them, as disconnected events that happen to coincide with getting richer. But they are three expressions of a single underlying architecture. The financial system is explicitly tiered. Each tier operates under different rules on different timelines, and the people at the tier above yours have a direct financial incentive to make the tier you're in comfortable enough that you don't urgently feel the need to leave it. The lobby is genuinely comfortable. The financial product stack aimed at people in the $600,000 to $1.2 million range is not malicious. It's calibrated to the fee extraction opportunity at that level, not to your optimal compounding trajectory. The 1% annual management fee isn't a scam. It's a rational business model. For them, and that 1% annual fee on $200,000 costs you $70,000 over 30 years of lost compounding. On $1 million, $350,000. On $2 million, $700,000. The fee never changes in nominal percentage. The cost in real dollars compounds against you at exactly the same rate your portfolio grows. The second elevator bank, the one that opens at $5 million in investments and delivers you to the floors — Dennis ended up on that elevator — requires a regulatory key card. The qualified purchaser designation, not net worth, not income, $5 million in investments. You can build there. Marcus built there in 12 years from $200,000 while doing nothing interesting. The only thing that would have derailed it was treating any intermediate milestone as a destination. Three things specific to these exact thresholds. First, run your investment number separately from your net worth right now. Your primary residence is not an investment for the purposes of the qualified purchaser threshold. Your car is obviously not. Pull the number that is actually deployed in the market: brokerage accounts, retirement accounts, investable real estate equity, and know precisely where you stand relative to the $5 million line. That is the threshold that changes your compounding universe, and you cannot build a timeline towards something you haven't measured. Second, audit the fiduciary gap in every advisor relationship you have. Ask one direct question: are you a registered investment advisor operating under a fiduciary standard, or are you a broker operating under a suitability standard? These are not the same thing. The fiduciary is legally required to act in your interest. The broker is legally required only to recommend what is suitable, a standard that legally accommodates product recommendations driven by commission structures rather than your long-term compounding trajectory. If your advisor is not a fiduciary, either find a fiduciary or get a fiduciary second opinion on every product recommendation that crosses your desk. Third, the $1 million milestone is an acceleration point, not a finish line. The United States added over 441,000 new millionaires in 2025 alone, over 1,200 every day. This is the threshold of the disciplined middle class, not the elite. If you're at or approaching it, the correct response is to identify exactly what it will take in years, in contribution rates, in investment returns, to reach the $5 million investment threshold, and run toward it with the same boring consistency that got you to the first million, without the detour of comfort products designed for someone else's margin, without the exhale, without staying in the lobby because the lobby has nice marble floors. Lazy investing built more fortune than crypto memes. And the people selling you the crypto memes knew exactly which elevator they were taking home.